the reason people either don't have a successful exit or don't get the price they want is because they're not prepared. The simple things are what you're doing by inorganic growth is going to show the next buyer that they can grow that way. So you have to be able to absorb that acquisition and show that you can integrate it culturally and that it's successful and profitable. Everything you do before going to market is de-risking it for the next buyer. Everything's based and priced based on a perception of risk from the next investor. What used to be just private equity is now so broad, and you're focused where there's over $4 trillion of capital chasing deals.
So Mike, one of the things that I think a lot of people get confused when they think about, who's going to manage my money is they think of financial advisors or traditional advisors, but then they've probably heard about family offices, but most people think family offices are just for the ultra wealthy. But can you just kind of break down the difference between your traditional RIA or investment advisor and then a family office?
Sure. Family offices there was a lot of mystique around them about 20 years ago. And it was typically a term for the ultra wealthy, the families that had made generational wealth, and they needed a team to administer their money. You're thinking CPAs, attorneys, investment professionals, manage cash flows, manage capital calls, manage private real estate. Like that kind of wealth required a full team of professionals. Roughly a decade or so ago, the term started trending more into a multi-family office offering, and not apartment building, but a team providing a similar service, but for multiple families. And as the trend went from, like a broker on Wall Street to more of a fiduciary or an RIA, those kinds of services started, the term was adopted for wealth management firms, So now there's the words thrown around pretty broadly. But when I think of a family office, I think of a office of professionals administering a lot of wealth and very sophisticated, complicated situations, complicated balance sheets, private positions, private real estate, private credit, private equity, hedge funds, venture capital, generational planning, tax loss harvesting, lifestyle management, paying pilots. We provide a lot of those services for the wealthiest families, including, investment banking and sophisticated deal-making professionals. So I think in the simplest term, it's a team of professionals to help wealthy families administer their wealth in a very efficient way.
And I've worked with lots of family offices, and it is a totally different experience for the client, than working with a traditional advisory firm, because it's full service and it's every aspect. But, what I find a lot of family offices are doing is really for the family, they're preserving principal is a primary function, and also then doing all the stuff you just mentioned, the tax planning, the estate planning, the legacy planning, all those things. But, a regular advisor or somebody that goes out, they're just looking to hire an advisor to try to make them more money. Would you agree that like most family offices are primarily their primary function is preservation of capital for the majority of the net worth, and then you got little pockets where you go venture and you go private capital and different things of that nature, or private credit?
Absolutely. I mean, the wealthiest families are already wealthy. The goal is to keep them wealthy, right? So you typically create your wealth with concentrated bets. You have a sophisticated reason for your making that concentrated bet. But then to preserve the wealth is basically based on diversification. So it's contrary to what you do to create wealth. So then to take your wealth and to keep making concentrated bets would probably not be the best way to preserve your wealth. So these teams they're first and foremost set up to preserve wealth and grow it responsibly. Typically, the founder of the patriarch of the family that generated the wealth keeps generating wealth, in their core businesses or how they made the money. They keep doing that, and then the family office keeps and saves those assets.
I think that's an important aspect because, the main income source is from money working for the family instead of the family working for money. And there's an interesting crossover that happens, in the wealth game, where you really do go from work, and most wealthy folks, I'm sure you know this, we know this here, they're going to continue to work because they love what they do, but they've refocused their energy on things they're passionate about, but they're no longer worried about, I got to work to make money to pay bills. They're now at a point where their money's working for them. Their teams, the family offices are managing that and then taking them into these new areas. And that's one of the things I really want to talk about is I really want to focus today on business exits, okay, and a lot of the mistakes made. And selfishly, I'm not going to lie, like this is more of stuff I'm interested in right now. So, let me just kind of unpack this, and then I think this will be really good for the audience because I'm sure a lot of the folks listening to this are either thinking about taking their business to an exit. Maybe they've already been through one and they're preparing another one because once you do one, you want to do more. But I'm in the middle of an acquisition of buying out a business, a large agency right now. It's roughly about a $14 million acquisition. Once that comes in, we'll bolt that to our enterprise of companies. And, we basically pretty much double our size just with this acquisition. Then from there, we're doing lots of, just workflow, AI integrations and all the things to really make everything operate without human interaction, except for the front line where they're talking to clients. That's always going to be human. And after we get through that, we're going to basically probably start working on how do we package this up to sell it. My COO of the RAA, he's done many, mergers and acquisitions, but like I know there's a lot of mistakes you can make. And, I've been around this long enough to know that I don't know what I don't know. And being where we're at, we're probably, let's say 60 to 90 days away from closing this acquisition. And we're already 5 months into the rebuild of the workflows and everything, which is a 21-month plan. And then that transition and all the integrations will probably take 6 months or so. But after that, like I got to really hunker down. I know what my goal is. I know what I want. We've looked at the EBITDA projections. We've looked at what the multiples are in our industry. What do I need to do now instead of waiting? Like what advice would you give to me? Because I know a lot of the audience is probably thinking the same thing with their business. Like, how do I bring this thing to an exit?
Yeah, it's really good you're thinking that way. I think the reason people either don't have a successful exit or don't get the price they want is because they're not prepared.
Correct.
So I would start being prepared today, which is what your intent is. There's probably 20 KPIs in your industry that you need to track. And what we do with clients is we'll create a dashboard for them, help them understand what those 20 KPIs are and how they stack up against their industry peers. That's going to help them understand how they're going to trade and if they're going to be attractive, and also help them time the exit. So if for example, if your customer acquisition cost or your margin or your management team or it isn't up to par with your competitors, then you're probably not going to get as much interest, if interest at all, or the right price. So there's a lot you can do to prepare. I would start speaking with an investment banker to help make sure that your business is prepared specifically for your industry. Mm-hmm. The simple things are what you're doing by inorganic growth is going to show the next buyer that they can grow that way. So you have to be able to absorb that acquisition and show that you can integrate it culturally and that it's successful and profitable, and show a roadmap for future acquisitions. Then try to show organic growth and what that growth rate is. And you want to go to market when your business is growing. And ideally, you want to go to market when you have a full org chart, so that it's de-risked. Everything you do before going to market is de-risking it for the next buyer. Everything's based on a perception of risk from the next investor. So all of your industry KPIs and all your thought process is, hey, if I'm going to try to get out of this, I need a successor. Like that's one thing business owners fail to do well, is make sure that
succession plan.
Yeah, there's a really good succession plan. Otherwise, it's just too much risk for a buyer.
Yeah, the good news is I'm being forced to do that succession plan now in this acquisition because they're requiring, the the financier is requiring the succession plan to be in place. So that'll be done.
Yeah.
That's
Yeah.
one less thing I got to do.
Yeah.
Well, but here's another thing. Like, where we're at in the cycle right now. You can see it. I mean, you don't have to look far. You can just look at the bond market. You can tell where we're headed. And, right now we've seen it, from going from 2024 to where we're at in 2026, it's been really hard to grow. Matter of fact, we've been contracting, from top line revenue. We've increased our bottom line profits, but our top line has contracted. So, and I see that happening for the next few years as we get deeper and deeper into whatever this next cycle is going to actually shape out to look like. But we're long overdue for a recession. And based on everything that I see in my 23 years of doing this, like I don't know how we go anywhere else. So it's going to be really hard for us to organically grow over the next couple of years. I'm just being a realist. And, if that's the case, but yet I want to kind of get everything ready for an exit, how do you grow when the entire industry or the entire market is contracting and it's almost impossible to have that kind of growth that we have in the past?
Yeah, you will have to grow inorganics through acquisition, and it would be best to wait until it starts taking a turn to seeing organic growth as well, because there's so many places competing for dollars. Mm-hmm. It'll be hard for a sophisticated capital group to want to enter a compressing market. So if it remind me, is it the lending or is it infinite banking or what?
Yeah, it's the infinite. So yeah, that's a good question. So it's the primary business is the infinite banking, which is just a general agency, if you really think about it, especially designed whole life. Then bolts onto that, we have an annuity division, we have an advanced planning division, we have a registered investment advisor. Those are the core hub of that enterprise. Then outside that, we have private money club lending, and PMC technology, which is the dating site for money, if you will, which obviously there's a lot of crossover that happens between the two, but we keep them separate. But from an org chart, everything is vertically aligned top down with the holding co, and then everything falls underneath that. And all of our workflows, our teams, and everything else also are vertically aligned.
Yeah, it's impressive. It's incredible what you've created, especially.
It's not been easy, man. I'm at a point right now, I got to be honest, where I'm like I want to just bang my head against the wall.
Yeah.
I mean, it's just one of those times where, you know how to grow, you know exactly what to do, but it's just everything you do, it fights you. And, I'm almost like, I was talking to one of my mentors and he's just like, sometimes in business, you just have to turn the dial down and just sit back and wait. And patience is the hardest thing, because if you just keep throwing more coal on the fire, but the fire won't burn any hotter, you're just burning, profits. He said, so sometimes it's better to just to pause, focus on efficiencies within your operations, focus on what you need, what you don't, and clean everything up there. It's the perfect time to do that. And then when the market kind of does contract and it finds its way, because it's just right now we're just in this weird, we don't know what way it's going to go. When it finds its way, then you plan you chart your course. Then you look at new acquisitions, because there's no better time to acquire than during a market compression. I mean, no better time. And I know that, and that's what we've been preparing for. We've been getting liquid for these acquisitions in this plan, but it's just that organic growth that I got to be honest with you, just gotten too used to, that is just not there anymore.
Yeah. Well, I think you're thinking about it the right way. These things do go in trends. And so if you can capitalize and do acquisitions, I think you'll be in a really good position when things turn, and finding different ways to get creative on acquiring customers. But I think you're thinking about it the right way. And if you can't do it, then it's going to be hard for anybody. So.
Yeah, right. I agree. I mean, we're the biggest in the space, in our little niche. So if we can't do it, nobody can. But it's just like, I don't know.
Yeah.
We're going to have to figure that out, man, because here we go.
It's not just you, right? Because other industries are facing headwinds too. We had a lot of clients in consumer goods, and they got hit with Liberation Day and tariffs, and they hit a headwind that was really impacted them. They couldn't really have any kind of capital event for a while. And now you're seeing inflation tick back up with Iran and the price of oil. And so there's always headwinds in different industries, and even in tech with AI coming in, tech valuations, which were sky high for a long time are now being super compressed. And no matter how good you are, even if you are growing, your valuations are compressed. So these things do go in cycles, and sometimes you have to re-innovate yourself. But the secret is just don't do a deal when you're desperate, and be prepared and keep looking forward and keep preparing and track your KPIs. I drop it. I announced a deal yesterday for one of my businesses. I created years ago a dashboard, tracked all our KPIs, knew where we stood. And when we felt ready, we knew it was time to go to market. We got a great deal with the group we wanted at the right price. And that's what I would recommend everyone do.
Actually, that brings up another question. So like when I look at the marketplace and I think, okay, who could possibly acquire us? I mean, at our size that we'll be at, I mean, a lot of the people couldn't acquire us. So, you're looking at banks, you're looking at, I don't even want to say the word, but private equity, which I don't think I'd want to exit to private equity. And then maybe just large, insurance agencies that are multifaceted or advisory firms. So who is the person that helps find that end buyer? Like, is that something your firm does, is tries to identify who the buyers would be?
Yes, that's what a good investment banking firm does, like a real investment bank. They know and spend a lot of time, money, and energy on the buyers, and the buyers are calling them daily, trying to figure out what deals there are to look at. A strategic that could use what you have to complement them and maybe help them grow is going to be a very likely suspect. There's a lot of new issuance. There are groups entering the market. So you have groups that didn't used to exist, like fund sponsors, family offices that are very active. Even like sovereign wealth funds have teams in the United States that are buying companies. So what used to be just private equity is now the landscape's so broad, and you're focused where there's over $4 trillion of capital chasing deals. And a good investment banker will go very wide. This deal like yours may merit going wider than others. You might call in 100 different types of buyers, create competitive tension, run a process, and have them submit so that you know what all your options are. And every time we do a transaction, our target is to get 10 IOIs. Sometimes we get more, sometimes we get a little less. But with 10, you have a good idea what the market believes your business is worth. But the top to the bottom are so wide. And so it's really important to run a process, because the odds of finding that one out of a couple hundred that's the top is just really hard.
That's really good. And folks, anyone listening, I really hope you just picked up on that. That was gold, what he just explained. But it makes sense. I mean, you've been doing this over 20 years, 100 investment banking transactions. So, it's not like it's your first rodeo. You've right. done it more than enough times to figure out this is the path, this is how it works. And that's why, when I was like thinking about what we're going to talk about, I was just like, listen, I hate to do this, but like, I'm going to be a little self-serving, because like this is exactly kind of what we are. This is where we're at, probably at that point where we need to start working with an investment banking firm like yours, and I know you're multifaceted in terms of what you guys do, so that, I think you guys could definitely help us a lot. But here's some other things I want to talk about. Business owners, they're not told a lot. Like, there's a lot of businesses, and I think let's focus on the service industry for a second. We'll get out of my industry and go into like the service industry, HVAC, roofing, and all those things. I know there's been lots of roll up there, and I have a buddy who exited his roofing company for north of 100 million. So he did well as a big company, but he made every mistake in the book. What are some of the most common mistakes business owners make when they get to a point of exit? And it was a private equity deal that bought them.
Yeah. I mean, the biggest mistake is they're not prepared. Meaning like their financials aren't in order. Maybe they're living out of their business. They've been paying their wife a salary who's not working. They've been adding liability unintentionally. Business owners really good at like using the business to go buy a boat, but they're not good at living off of a portfolio. So you got to do all your personal planning. You make sure you're being very wise to make sure it's tax efficient, that you have done the homework to know what number do you need to create a lifestyle that you've had while you owned the business. and do other things you can to de-risk the business. So every time you de-risk it, and that's things like not having customer concentration. Like if 50% of your revenues from one customer, no matter how long they've been your customer, is a high perception of risk. So it will keep people from being interested, and it will keep people from paying a good price.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
So business owners, oftentimes, if they're not sophisticated or haven't done it before, don't have good advisors, they'll just call when they feel like they're done and they're tired. And instead of having foresight to do all the preparation to make sure that they can have a successful outcome with their personal planning and that the business is ready, is probably the biggest mistake. The second is getting a bad lawyer that doesn't just do M&A, because a bad lawyer will blow up a deal. And the third reason deals like don't go through that we see most often is with the numbers deteriorate during a process. You have to your numbers. You got to hit them, or else you're not going to be able to get a deal done.
Yeah, you definitely want to kind of be doing it when you know you're going to have a nice trajectory during the process, because it's a long process. So why is it that business owners hang on so long? You know, like I even feel like, you know, with this acquisition, it kind of pumps some life into me. But, you know, I'm 48, going to be 49 here. And I feel like I waited too long, you know, to kind of get to that exit point, because there's just so many other things I want to do in life. It's just, but so many business owners wait till they're just beyond burned out. And that's when they decide to exit. And that's when that's just when they're most vulnerable, because they're so checked out of the business. They're not doing the new things. They're not focused on all the things that are actually necessary. And they just want out. They want to be done. Their kids don't want to take the business over. Is this pretty common?
Yeah, it's common for founder-led businesses. You know, I think they hold on maybe longer than normal because a lot of them, that's their identity. I think that they do make money along the way, and so a lot of them don't need a career-ending injury, and then they end up eroding equity value by kind of getting tired. And so I do feel like I tell my clients that Malibu's full of people who sold too early, meaning you want to maximize your efforts when the equity value is at the highest and you're fully engaged, and have a plan, because most don't appreciate that if you start preparing today, it may take 2 or 3 years. You do a transaction and they may keep you on for 2 to 5 years.
I would certainly want that. I will. Yeah. That's part of my plan. I won't exit unless I can stay on, because I'm not done. I just don't want. What I used to do that I loved is not what I do today. You know, so it's like the only way I can get back to that is to get out of the driver's seat, get out of that CEO seat, and get back into what I actually loved, which is exactly what I think someone acquiring would want me to be doing.
They do. It's also sometimes I feel like irresponsible for your family to not get some liquidity. If you have a high concentration of your wealth wrapped up in your company, at some point it's irresponsible, because there's a lot of unforeseen risks. No one predicts black swan events, but they always happen. And every industry is susceptible to risk, no matter what business you have. So if you're not preparing your personal and your family's life and financial situation, I think it can be irresponsible.
How long prior to an exit do you think someone should start working with a firm like yours?
Well, I think it should be like as soon as possible, because there's some planning tools like that you want to take advantage that if you're going to try to implement them can take up to 5 years. Like QSBS, if you want to have
my time frame right there.
If you want to have tax-free proceeds, then you need the government will require that you have that seasoned for a period of time. Mm-hmm. And then some other planning things. If you're philanthropic in nature, you want to set up a legacy of philanthropy with your family. You want to start implementing some of those strategies. also just like exposure. You want to have like an asset protection trust. There's things that you should do regardless, but will make your exit more impactful, and it'll help you understand what number you need. A lot of business owners will be like, well, I want to sell my company. And we're like, well, what do you hope to get out of it? And as much as I can. Well, like, that's great. Everyone wants as much as you can, but how much do you need for your goals post an exit? And do you plan on staying on like you do? Not everybody wants to. And so if you're not going to draw a salary, you got to draw it from your portfolio. Well, what does that number need to be? So I think like, and getting comfortable with all of that, because it's a lot. You know, I think the reason the family office exists because you're a professional like that, they're a business owner, their life gets super complicated. When you start having a lot of K1s and an estate and capital calls and taxes, and it's like you need to be prepared, or else you're just not going to have a good outcome.
So you're saying the time is now.
The time is now.
Let me switch gears a little bit. Your firm manages, based on what I'm looking at, a little over $3 billion, which is a pretty good sum of money. Now, when clients are looking at someone like you in Crewe, where does that start? You know, like what level of investable assets, net worth, income, you know, whatever the metrics are that you look at, like where does somebody become, you know, a client for you, or where does your firm look at somebody and say, hey, they would be a great client for us?
I think that I mean, I would probably say if you have some complexity, you need, you know, we have CPAs and tax attorneys and CFAs and investment bankers and lawyers. And so you don't want to pay for that if you don't need it, right? So if you're just a simple W-2 stocking away cash, then you probably don't need us. Our typical client is a business owner where they can have a family CFO with sophisticated professionals around a complicated situation, help them with their operating business, help them with private capital transactions and advisory. But I think, you know, we're not above talking to anybody, but our typical profile is somebody with some complexity, somebody that understands that their time is valuable. They need really good advice. They want to take the friction out of their finances, and they also want access. I think, you know, it's anyone can go on and get an ETF or get access to the market or use Robinhood. But when you start doing private investments and private real estate and access to private equity and things like that, it's good to have a team that has the professionals and the sophistication and access.
Love it. We're in the midst of, you know, what a lot of people have been talking about is the largest wealth transfer in history, the silent generation, the baby boomers, you know, obviously not getting any younger. None of us are. So as that money starts to come over, I fear for a lot of families because, like, there's just no one, it doesn't seem like people are ready for this level of wealth transfer. I mean, I have dealt with so many people that have, you know, had a family member pass away. They inherit a large sum of money and they literally have no clue what to do, but yet they won't do anything. I don't know why, but they just, then, you know, the story, they just squander it, you know, and you could speak about, you know, the Vanderbilts versus the Rockefellers. I mean, what are you seeing and what are you guys doing to attract this new wealth transfer?
Yeah, I think that's a real issue. I think this next generation, especially those graduating post-COVID, had a different experience than you and I, and the world's gotten easier for them. We work from home, they study from home, like everything's at a click of the button. Like they don't text back. It's just like a whole different, group of people. And as they're aging, they have these habits that maybe the tough times didn't strengthen them, and it's easier to maybe take things for granted and an easy come, easy go. And so what a lot of wealthy families that are worried about this is the next generation 2 and 3 is they incorporate them in all the family planning and governance and start the relationship with G2 and G3 now. And not only that, but like if you're wealthy and you wait till you're dead to pass on the money to your children, there could be a lot of resentment. So you want to get in and create and strengthen families with money, not ruin families. And the sooner that you can incorporate them and talk about it and explain it and educate, the higher probability you'll have of having a stronger family and keep the wealth than not. And there's a lot of great examples. Like we'll bring clients in who have done a really good job with it and share how they've done it with other families.
Oh man, that's awesome. Yeah, it's definitely, it's a problem that's just going to get bigger and bigger. And, there's just not enough people doing the proper planning beforehand to make sure that there isn't that. And we're seeing it. I'm sure you're seeing it, and it's just going to get worse. Now I want to go to your upbringing. And, when people see a podcast like this and they see you in your office, you're clean cut, you're well dressed, you got a really nice office. They always just think that you were born with a silver spoon in your mouth.
Yeah.
Your story, my story as well, is nothing of that sort. Can you just go back and just tell people, because folks, I want to just frame this up. So Mike started this firm at the age of 30, he had 0 clients, no outside financing, no outside, private capital or private equity to help him out, just a single $20,000 retainer check. Now, granted, that was 2011, so it's been some time that's passed, but I think this is an important story for people to hear, how you built this conglomerate or enterprise of, what you now have is your firms. But talk about just your upbringing and what drove you to want to do what you do now.
Yeah. Honestly, sometimes it's hard to talk about, but
yeah, I'm sure.
I grew up in a very, like most, I used to think it was kind of unique that I grew up in a very poor family. And for most of my adolescence, at least the formidable years, we were homeless. And we weren't on the streets, but there was generous families that took us in and took turns housing us. And I think that really created a drive for me to not want to be poor. And there was a little bit of a part of me that I felt wasn't as good as others because of that. And my siblings and I all handled it differently. The way I handled it is, instead of blaming the circumstances, is I chose to go do something different and go take it. Like, no one was going to give it to me. And if I didn't want to be in those circumstances, if I didn't want to raise a family that way, I had to go do it myself. And so at a young age, I got a job and I paid it for everything for as long as I can remember as a young boy. I got my undergrad and started off as an entrepreneur. And, one thing led to another, but it was just a lot of hard work. And it was the goal of, originally was not being poor, was my original aspirations. And I feel like I've always looked at this industry about solving problems for people and adding value and doing right by people, do one step at a time. And as you add value and help, the world rewards you. And it's been a wild ride. The young version of the young self would be really happy and proud of where we've come, but it's hard to even take a look back and really enjoy it, but because you still feel like the young poor boy I was when I was a kid. But it makes me very grateful for what I have and don't take things for granted.
Personal question. You don't have to answer this if you don't want, but you ever find yourself in your mind drifting back to that scarcity mindset instead of the abundance?
I think so. I think I definitely live an abundance life, and that's who I am for sure. I believe there's enough business for everyone. I definitely feel like a bigger pie guy. But in my little life choices, buying gas, buying groceries that are no longer an issue still can cause me a stomach pain, So there's parts of my life where it might be hard to ever overcome that. I find it soothing to spend money and not have to think about it sometimes, because it does cause that feeling. But in general, I've learned to become a big pie guy.
Yeah. And I'm just like you, I'm a very abundant, like, thinker. I know there's more than enough, and, you just disrupt the flow of money and you make more. But I find myself, more than I like to admit, drifting back to that scarcity mindset. You go to a concert and, your spouse, and the people you're with all want, the $50 t-shirts. My mind goes to, why would anyone pay $50 for this Journey t-shirt? But yet it's just in the moment. And is $50 going to do anything for you or me or the people listening to this? No, but it's just ingrained that, as we grew up, you would never even dream of that. You wouldn't even ask for it, think about it. And now, yes, just because you can, to me, I'm just like, oh, gosh, it just happened. That's why it's so fresh. And I think I just needed to know that I'm not.
I have it all the time too. I think that's why they say the greatest generation of all time. They were products of the Great Recession or Great
Depression.
Great Depression, and that's exactly what they had, right? So there's micro versions of that from guys like you and I. But I think the challenge and the difficulty and the hardship is what makes somebody strong. I've never met a strong professional or a strong entrepreneur that didn't have a hard past, and I'm grateful for that. I hated it. Like, I don't wish that on anybody, but it's why I am who I am. And I'm grateful for the hardship. And that's why when you said your wealthiest friends still work, I believe, because that's where all the growth is. And I don't know how you can teach your children how they can grow if you're not working and leading by example. So there's so much blessing in hardship. Like, I don't think you want to put it on yourself, but it's going to come regardless, because that's just life.
And I think the final segment I want to kind of cover here with you, Mike, is I want to talk about giving, charitable giving, foundations, and all of this. I guarantee you there's not a client you work with that doesn't have that as a primary goal, is to give, and give more. And, I know you do a lot. You have your golf, I don't want to call it golf outing, but the Crewe Cup, so talk a little bit about that, because I'm going to go back to that scarcity side, when I was young, like, you're always, when you're younger and you're fighting just to make ends meet, you're always like, I'll give when I make enough to give, but that is the absolute wrong mindset. And years ago, probably a decade ago, I'll never forget. I don't know what happened. Maybe I don't know, something happened to me. And how we all get envelopes that come in the mail? And they, for a fact, it's somebody asking for money. It might be Make-A-Wish. It might be the Red Cross, whatever, and we all have these preconceived notions in our mind of, Red Cross, that CEO makes X amount of money, like that. None of the money goes to a good cause. And I used to get wrapped up in that because that's how my mom was. But there was one day that I just said, you know what? There was a couple, I got one in the mail. I took it out. I didn't care what the company was. I grabbed a check and I just wrote a check for whatever I felt like writing it for. It might have been $5, could have been $10, could have been $1, didn't matter. And I sent it out. And then more came. And I got in the habit, and I did this for probably 6 months, where every one of these that came, I never looked at who it was, never looked at anything. They even started sending me quarters. I got up to the quarter level. Like, that means you're giving a lot. And I would just stroke a check every single time. And I just kept doing this and doing this and doing this. But what that did for me is it really, really put me in a place mentally and probably physically, because I'm sure there's more than just mentally, where the act of giving wasn't tied to something on the back end. I wasn't giving because I thought I was going to get something, get recognition, this was just a private thing I did in the quietness of my office that nobody else knew I was doing. And it felt good. And it paved the way, because now we have our private foundation. We give deeply to animal shelters, child trafficking, our daughter's school. But it's probably been the most rewarding thing out of everything that I do. So, talk a little bit about your journey with that.
Sure. Well, I think I learned this luckily at a young age. I started my first company when I was in my early 20s to pay for school. And it grew and was pretty successful. I had made more money than I anticipated. The Great Recession hit. I had an 8-figure net worth and went to a negative 7-figure net worth quick. And I realized that the money wasn't fulfilling. It was the small amount of service and donations and philanthropy that I had done, which was relatively small at that time. And I told myself if I started another business, when I started Crewe, I was going to build something at the same time that wasn't about making money. I just something about what I think is actually fulfilling: relationships, experiences, and philanthropy, service. It is like the secret to life. Like when you're serving, your problems suddenly seem a lot smaller. It brings joy. The money is not the answer. It's a problem if you don't have it, but service is the answer, and we're deep in relationships. So it's been a core part of building this firm. From the very first day we started our philanthropic endeavors, the Crewe Foundation has given away over $66 million. Our events have raised millions of dollars. It's a core part of my DNA and who I am. I mean, even I'm always trying. It's not always easy. I'm not perfect, but a small example is even yesterday I saw a donut shop that had these gluten-free donuts, and I knew this neighbor boy was gluten-free, and I brought him to him, just thought of him, and he almost cried, and he gave me a big hug. And I was just thinking, man, that small gesture, I just gave this kid a donut, made my day. Like, why aren't I doing more of this? And so with that kind of perspective of just giving and serving, you think you're helping others, but in reality, it's just really making you happy. And it's the secret to life.
You nailed it. And it is those small things. And, no matter what the listeners, where they're at, in their wealth journey, even if you're at the very beginning and you barely can make ends meet, just find the small little things that you can do that make someone's day, like that gluten-free donut.
Absolutely.
You had just mentioned that is sometimes the most valuable things. The 66 million you gave away, and the millions that we give away, like that's great. But I love that you went back to that simple thing, cost you a couple bucks, but
Exactly.
almost cried or did cry, or I can't remember whether you said he cried. But that's so meaningful. And I think that is literally the secret to all of this. It's like, back to where I began the conversation with the exit, I have a number that I've had in my head for, now 6 years. I've had the deposit ticket in my back pocket, just like Mr. Jim Carrey, did with his check in his back pocket. I know exactly what I want to exit for. And when I tell people, sometimes I feel like I'm being shamed because they're just like, why would you need that much? And the simple answer is I certainly don't. And I never will need that much. But the thing you have to sometimes do is when you limit what you are worth, you're limiting what you can give. So if your mind says, oh, I'm not worth that much, or I don't need to make that much, you got to take you out of the equation. Because for me, the number gives me the ability to give almost unconditionally. And I probably would give most all of it away because I would never need that much, but that is exactly the point. Strive for the biggest number you can. Strive to make as much money as you can, not so you can have the more Lambos and Ferraris and bigger houses, but so you can give more. And if you give, you already know you get, because that's the way the universe works, but it's just about the giving. And that's what it is to me. So I'm sure we're going to be talking after this, Mike, about helping me bring this to the exit. And, I think the greatest reward the after the exit won't be getting the check and figuring out what I can buy with that money, because I live a good life now. I really don't know what else I would need than that I have now outside of time. That's the biggest desire. But having that gives me the ability to give and not be restricted, and that's the most powerful thing.
I agree. I was going to add, and you mentioned it at the end, by having your family financially independent, you're also able to give of your time. The currency that your family values most isn't your money, it's your time. Mm-hmm. And you can't give your time if you're not financially independent. So I think giving not only of your resources, but of your time, your most precious asset. So totally aligned.
Mike, this has been phenomenal. Now, people listening, if they've made it to this point, they're probably thinking how would I get a hold of Mike Bennett and Crewe Capital and your other companies? What is the best place for people to start?
My website's just crewe.com, but it's spelled CREWE with an E on the end.com. And my email is m@crewe.com. So M is in Mike at Crewe, CREWE.com.
Dude, that's so simple. I love it. And when I first saw this, Listen, I'm an 80s kid, and I used to be a huge BMX kid. And Crewe, I don't know if you know this, but like, remember the movie Rad?
Of
Crewe Jones?
Yeah,
Like,
of course.
I'll never forget the name.
Crewe
of your
Jones was
company.
a killer. Yeah. No, I actually named it. I did a master's or a graduate degree in the UK, and there's a city there named Crewe, Crewe. And my experience there was so inspiring. I was trying to pull from that region of the world. And there's a city named Crewe that they make Bentleys. And I thought it's like the Michigan of England. And I'm like, I want that inspiration. I want to be the gritty, hardworking group making this world-class product. And that was originally the inspiration behind the name Crewe.
Oh, I love it, man. It's such a good name. And I love that you kept it super simple. And you know, sometimes simple, stupid is what gets you where you are, and you're doing great. So thank you so much for your time and coming on the show today. And folks, if you're listening, we're going to put all that in the description, so you didn't have to remember that. Not that it was difficult. m@crewe.com. I think you can probably remember that, but we'll put it in the description just so you know how to get a hold of Mike and his team, and also crewe.com. We'll throw that in there. But anything you want to say before we end this podcast?
No, thanks for having me. I think you've built an incredible community. It's an absolute pleasure and honor to be here and a part of it. And I'm excited to continue to listen to your podcast. You've done a great job. I'm grateful to be here.
Thanks, Mike. And I look forward to chatting to you a little bit more about the stuff that we talked about in this podcast and helping me kind of position so that I do the exit the proper way without the mistakes that I'll make without your help.
Absolutely. We would love to anytime. Give me a call.
All right, folks. Thanks for joining us for this episode of Money School Elite. We will see you on the next one.